And good afternoon. Welcome into Market Talk for this Wednesday, May 11th. Great to have you with us once again. Thanks for making us part of your day. I'm your host, Jesse Allen. Find us online. MarketTalkAg.com is our home on the web. MarketTalkAg.com, where you could find us. All of our social media links, our radio affiliates, our streaming sources, the latest news of agriculture, and much more. It is all online at MarketTalkAg.com. Well, we saw buying come back into the trade here today. Good strength throughout the grain markets. Really, the food and fuel commodities saw buying here today. We have a WASDE report tomorrow, so plenty to discuss on the show. Let's bring in our good friend Mike Zuzolo with Global Commodity Analytics joining us here today. Mike, good afternoon to you, sir. How are you?
Doing great, Jesse. Thanks for having me back.
I appreciate the time and glad to have you back on here this week, Mike. Lot of news items swirling around the trade here today. Overall, though, as I kind of mentioned there, the food and fuel-based commodities really saw some good buying strength here today ahead of that WASDE tomorrow. I know we got the CPI numbers out this morning, so a lot of things stock market and outside macro-wise to watch. But overall, as you look at the closes here today, what's your initial reaction?
Well, the consumer prices are not backing down. And what was really interesting about this consumer price index number at 8.3% year over year versus a poll by Reuters of 8.1%, so quite a bit higher than what the poll was expecting. That's even given that the energy prices saw a big decline in the month of April. And the CPI number came in at about 2.7% light on energy, Jesse, and that was because we did see a big pullback in gasoline prices and crude oil prices. But since the lows were made in the RBOB gasoline, we're up about 20, almost 30% now from those price levels. So this CPI is not going to go anywhere but higher at this stage of the game, and with energy probably leading. And I think that's what we saw in Wednesday's trade. Was the trade really honed in on the food, and they really honed in on the energy. They really honed in, excuse me, on those core numbers, because those core numbers are not backing down. And I think that really caught the market by surprise. I would say this, that given what the CPI data look like, if we could get a sell signal in the dollar, I think we might be poised during this next 60-day time frame to see maybe stock market money run over into the commodities and see the commodity bulls get picked back up again on the inflation day that we just saw. And I say that, as you say, we've got a producer price index number coming out Thursday morning. I say that very gently, very tenderly, and gingerly, given the PPI number, I don't know what it is yet, and given that the WASDE numbers are coming out with brand new 22, 23 stocks figures. But these numbers today clearly show that the inflationary pressures are not backing off. And I think the investor class is probably wondering if they're not light and too light on their commodity holdings. I've talked to a couple of financial guys lately, and they're still sticking with like 5 or 7% of their holdings in commodities. And to me, that seems too light. Even though I don't have a stockbroker's license, if it were just me, I would probably be closer to 10% as far as what I would be holding in terms of a portfolio if I had to make that determination.
Well, Mike, I want to talk a little bit more about the energy side before we dive into some of the other topics you mentioned. You looked at RBOB gas, and let's pull that up here and go through this chart here on the video and just talk about what you are seeing with this chart and explain a little more.
Yeah, a couple things here. And the key with this chart for me, Jesse, is that the RBOB is in blue, the WTI crude oil is in black. Look at how far away. We're still about $20 a barrel away from the highs in the WTI crude at this stage of the game from those March highs that we put in the very early days of the month of March. But look how we are racing back up to and even above the March highs in the unleaded gasoline. And I think this makes a lot of sense because we're in the summer driving season. We have extremely tight supplies of unleaded. We have even tighter supplies of distillates, which we'll get to in a minute. But the key with this chart, I think, is that the higher the unleaded goes, the better it's going to be for ethanol demand, and the better it's going to be for ethanol demand at the pump. I talked to a client in Nebraska earlier this week. There is a full $1 per gallon discount in E85 versus what he could get for E10 or E15 at a standard gasoline station in the heart of the Corn Belt. And so if you can get to those stations, you're going to see more and more volume pick up on the ethanol side, because this unleaded market is leading the charge to the upside. It's not the crude oil market. The other thing I like about this, Jesse, is that when the crude oil doesn't lead, it makes me feel as though the speculators are not really too heavy in the energies. The commodity index funds are not too heavy in this market. And that kind of goes to my earlier point. I think the index people, the commodity bulls from, back in Jan, Feb, March, after that March high was made, I think they kind of ran for the shelter and liquidated a bunch of positions. And I don't think they've picked those up again. So I don't think we're at an extreme at all on the long side in crude oil, which is very healthy for this time of year.
Well, you mentioned distillates. Let's flip charts, talk and look at distillate stocks, and go through what you're seeing here, and maybe kind of wrap a bow on this whole conversation for us, Mike.
Yeah, we'll stick with unleaded. It's the blue line again, and we see that it's been dropping steadily all of 2022, even though gas prices are now hitting another record high of what was it, 473, I think 473 and a half, or something around there, is a brand new record high this week again. But we continue to see those stocks go down. But the really key to the recession potential, and I'm still calling for a recession as of Q4, as we get into the fourth quarter of this year, in part because of the high interest rates, in part because of the distillate stocks in red. That distillate stocks number at the very bottom right of the chart is about 104 million barrels right now. We just this week on today's numbers took out the 2008 lows way over on the bottom left of the chart, that low at the red line. That low has been taken out. And so we're literally dealing with 20 plus year lows in distillates, and that's your diesel. And that's what fuels the economy. And that's why I think this inflation's not going to go anywhere anytime soon, because these distillate supplies are so low. We're going to continue to see higher prices. We've seen companies like Tyson Foods, they reported earlier this week, they raised their prices anywhere from 11 to 20% on their beef and their chicken and their pork, in part because of their costs. Those costs in part higher due to grains, but also due to what we're dealing with in the energy markets. And so I think this is where, again, if I could get a sell signal in the dollar, I think that would bring in more of the bulls on the emerging markets and in the commodity inflation. And I think it would really come at a welcome time, because we're going into the, pretty much the heart of our crop year. So that's kind of the macro picture right now.
Well, let's turn our attention to Thursday's WASDE report, Mike. And as we mentioned at the top, that is our first look at the 22-23 balance sheets. Now, I know typically USDA history says they're probably going to use the February Outlook Forum yield estimates, 181 corn, 51.5 soybeans. I have to wonder, with all the planting delays and everything else, could USDA surprise the trade and alter those numbers slightly? I don't expect that, but one has to wonder if USDA could throw us a curveball, considering everything that has happened since those February outlook numbers, Mike.
Yeah, great question. I think they will throw us a curveball. I would look for it more in the acreage base when it comes to corn and beans, though, Jesse, at this stage of the game. I'm like you, it's a little early to go after the yield side of the equation, even with these planting delays. But what you essentially illuminate here is that this is the May report. And we've got crop insurance companies in the state of Kansas and Oklahoma right now zeroing out fields of winter wheat. And this is where, if the May report and the USDA is going to be timely and be ahead of the curve, it's going to be in the wheat complex. And that's why I really feel like this week has done a lot of good for the analysis, because the wheat has continued to underpin the corn and beans. And I think the wheat in general has given the corn and beans the upward momentum that we received on Wednesday after the inflation data. Had it not been for the wheat and the soft red wheat earlier this week making a new monthly high for the month of May, I don't think we would have seen $8 May corn again like we did on Wednesday. So I'm really laying hard into the idea that USDA's got to come down on either their harvested acres and or their yield. And so what I sent out to clients this past weekend on the weekly commodity brief were my updated estimates. I'm now below a 45 bushel yield for all wheat. USDA is working the 49.1 from the February baseline numbers. Talk about a stale number given the crop conditions, not just in Kansas, not just in Oklahoma, but in Illinois and in states like Indiana. Most of the states in the soft red and hard red wheat belt this year in good to excellent are below where they were last year at this time. So it seems totally justifiable to cut the either harvested acres or the yield. Now, keep in mind the Reuters Refinitiv estimates, which I don't put out my estimates to the news wires because I don't allow the hedge funds to trade my estimates. And that's what they do. They essentially ping off the highs and the lows and the average and trade around it. But the low number for the 22-23 ending stocks for wheat is 550 million bushels. I'm at 453 on this spreadsheet, as you can see on the right-hand side in green. That would put us at a 21.6% stocks to use ratio. That would slash our stocks to use ratio compared to where we are right now. Do I think USDA is going to give me all of that tomorrow? No, but I sure would want them to start cutting the yield and not messing with the demand too much. So I would like to see those exports remain around 950 million bushels. I'd like to see that stocks to use ratio at least get down to 23.5% as a first shot, and then expect more cuts as we go down the pike. And if I can get that, that really underpins the downside potential in the corn and the beans. It puts, I think, a floor underneath us until we know what the size of the corn and bean crop is, which goes right back to your question about what's this yield going to be in corn and beans given planting progress.
Well, and yeah, and to look at that, I'm hearing rumors of anywhere from 500,000 to 1.5 million acres of corn potentially in parts of the northern plains not getting planted, prevented plant, just with, how much rain, snow, and moisture we've seen in North Dakota, southern Canada, Manitoba, northwest Minnesota. I know there's a lot of concern there. And then, of course, this week, planting progress, Eastern Corn Belt, we're expected to be, have a better number after this week with planters rolling there, but the kind of the northwestern belt dodging showers and thunderstorms this week. So I think that's another thing the trade is watching as well as we head into Monday of next week. What does that crop progress number look like, Mike?
Yeah, I think you bring up a massive point, and it goes back to what you and I talk about a lot, and we'll keep talking about. Is this a 2008 style market where the wheat leads? Or is it a 2012 market where the corn leads? And we're trying to figure that out. But right now, I'm still putting my money on the wheat side of the equation, in part because of the northern plains. You're exactly right. The spring wheat was up 3.5% on Wednesday's trade, mainly because of the planting delays that everybody's now talking about. And I talked to a client from northern Nebraska who has a lot of friends up in Saskatchewan, works with some cattle guys up there, and also has a fishery up there as well. And he said, look, I'm dealing with guys that are just not doing anything at this point. They're essentially 2 weeks behind now, and they're not seeing a lot of daylight because the weather models continue to give us quite a bit of wetness and quite a bit of cool weather. So I do think the wheat is still very much the leader here. I want to be able to say that tomorrow after the WASDE report. But if that's the case, then we're still on track for like a 2008 style market. So that's kind of where I'm laying as we go into the end of the week. And as you progress through this time period, and kind of more to your question is what does that do to the corn market? Well, that just underpins the corn market more because there's not going to be a lot of substitutes for corn. What if the Brazilian corn crop is cut in the WASDE report tomorrow? Well, then all of a sudden you have a tighter wheat crop and you have a tighter corn crop. And then all of a sudden the trade probably goes back to thinking about Ukraine and Russia and saying, where are the supplies at? So this is the dynamic we're in right now. I'm putting a lot on this report. I'm putting a lot on the charts right now, Jesse, because we tested some really key support levels in corn and beans this week earlier, monthly chart support levels on the lead month futures. And with May futures going off the board here on the 13th, a lot happening right now. So I will take the fundamentals and the technicals and look at them both and take them at face value.
And we have CONAB numbers tomorrow too. You mentioned South America. So we got to think about that as well. And I pulled this weather map. I just want to pull this up to bookend our discussion on the video side real quick. But, you mentioned some of those concerns you're hearing about more moisture, over an inch of rainfall in the next 10 days. I mean, high probabilities in northern plains once again, and even some scattered pockets here throughout that western corn belt. So that is something to keep in mind as well here, Mike. Let's shift our discussion to livestock. Live cattle on Wednesday had a fairly good day. Cash cattle trade's been fairly slow so far this week, but I was impressed with how live cattle fared today. Feeder cattle under pressure with, of course, higher corn prices. I would have to think that was a big weight there. But as you look at the cattle markets, what are you seeing here this week? What stands out to you?
Yeah, the cash index and the hogs and the hog futures are finally at parity, right around 100, 101. So we've seen a big drop in the belly prices. We've seen the big correction in the cutouts. I really want to say the hog market is trying to find support, but it's got one eye not only on China's lockdown, but also on the other eye on the equities markets. And so we're still open to more downside in the fat cattle, especially if the hogs want to take out their recent lows. They shouldn't need to, I think, fundamentally, Jesse. I think we're probably going to see a lot of pork consumed here this summer in the summer grilling season, the way this consumption pattern and these record high gasoline prices are running. I think you're going to see people go after the cheapest thing out there, and the cheapest thing out there is going to probably be a lot of pork cuts at this stage. So I think the cattle found support off the hogs. The other thing I like about the cattle at this point, I don't know if they're going to rally sharply here, but I like the fact that we went down to 132.50 in the June fat cattle, or 132.35 in the June fat cattle. And we saw the central stockyards Texas trade at 137. We've seen light trading and testing here in Kansas at 140. We've got a $6, $7, $8 discount in the June fats on the board versus what the cash market's trading. I don't see the cash market weakening much at all here because we're really in summer grilling season. So it really opens the idea up. Can we get a rally in the futures market to put some premium on the futures to get them closer to the cash market? And that's what I'll be watching for. Keep in mind the WASDE report on Thursday will also give us fresh meat numbers. I'll really be watching per capita consumption, exports, anything demand related because of these prices. Going back to the Tyson earnings, for the first half of the year, Tyson reported both pork volumes and beef volumes down over 2% versus the prior first half of last year. So we are losing consumption at this stage. And it's not because we don't have the animals, it's because of the prices. And I think that's where we really got to be careful. I don't look for summer grilling season to be nearly as good this year as it was last year, because we're not going to have the stimulus checks, and we're going to have a higher price beef and pork and poultry market, and obviously record high gas prices too.
And you throw in HPAI in there, the worries about what's going on. That continues to spread, trying to get some funding maybe to help out with that from Congress. Just a lot of things swirling around this livestock market and demand. And not to mention, we have weekly export sales numbers tomorrow, too. So what will we see there? Will we see anything beef and pork wise that give us a pop one way or the other in these markets ahead of the WASDE?
Yeah, that's a really good point, because we do have an excess supply of pork right now. And so we really do need the pork exports to remain fairly strong. But if you take a broader brush and take a couple steps back, we're still looking at reduced supplies as we work through the summer. And as we get into the third quarter, we should start to feel those reduced supplies quite a bit. Now, does that come up against a recession? Well, that's where it goes back to the energy prices. That's where it goes back to the inflation side. We're just going to have to keep an eye on that. But I don't see a premium in the back end cattle to hedge right now. I guess that's what I'm really just keeping my eye on at this stage of the game.
Well, Mike, great stuff as always. Got a busy rest of the week ahead. Any final thoughts you have for us before we run out of time?
Well, you asked a question a minute ago, Jesse, and I think it's really important for the clients to realize, and the listeners to realize, that the Wall Street Journal contacted me yesterday and asking about the national corn yield and how likely it is for us to be able to get that 181 national yield given the planning delay. So don't get too far ahead of yourself thinking that this market's going to go higher, higher, and higher on the weather, on the supply demand, because we're pricing in potentially already some lower yield on the national corn. So we could be pricing in smaller acres and smaller yields. So just keep that in the back of your mind, because they're talking about it right now in the trade. The media is writing about it right now. My take, what I told the Journal, was very simple. If you can't get the 3 I states in Minnesota better than 75% planted by the end of May, that 175 yield is probably a top end for the national yield. And that's what I'll bake into my numbers.
Well, Mike, I know if producers want a little look at your analysis, want a big look at your analysis, they can go to your website and sign up for a trial, can't they?
Yes, go to the website globalcomresearch.com and sign up for a 3-month trial. And if you have any general questions, give me a call on the toll-free number there on the website as well after the market closes, and be happy to talk to you.
Well, Mike, we appreciate the time as always. Thanks for joining us this week, sir, and have a great rest of your week.
You have a great week too, Jesse.
Thank you very much. Mike Zuzolo with Global Commodity Analytics. That's going to do it for the show here today. You can find us online, markettalkag.com. I'm your host, Jesse Allen. Have a great evening.